So, hello, and a massive hello to everybody. How we all doing? Rocking and rolling in a free world. Let's do this. So, hope everybody's having a great day. Let's get this party started and let's see what's going on. So, we're here to talk a little bit of shop, and nothing's off the table. No trade calls, no recommendations. Everybody's responsible on their own stuff. We're here for educational purposes only. So 17th of June, let's do it. Just happy to answer any questions, discuss anything anybody wants to discuss. Got some people saying volume's a little bit loud. Can anybody confirm? I think you can switch it down on both on the Adobe Player on your own computer, but it should be fine because we have sessions every single day and the settings haven't changed. So I see Alex is in the room. I see a couple of usual suspects are in the room. Can anybody confirm how volume is? Hey, Tim, and how's it going? Volume's okay. Okay, so it looks like it's fine for most people. Let me know if it gets too annoying. So yeah, I'll just go through the questions one by one, and I don't, I can hang around. We'll just take care of whatever comes by. So please don't hesitate to ask. I'm the only one who can see the questions, so don't be shy. So what's happening? I think the first thing is just I'd like to also wanted to do this session because this week's going to be fairly interesting. There are a lot of things going on, and I just wanted to, for some of the newer traders, I'd just like to point out that this is really not a week to try and be a hero. It's never really the time to try and be a hero, but especially this week. We've got pretty much every central banker on deck and a lot of stuff coming out, okay? So we've got Draghi speaking 3 days in a row. We've got Carney speaking. We've got Karuta speaking. We start the week with, monetary policy meetings out of Australia. We've got the CPIs coming out. We've got a Fed meeting with a press statement reminder. Now we got press conference after every meeting. We got GDP out of New Zealand. We've got RBA speaking. We've got the BOJ press conference. We've got the BOE press conference. It's just going to be, steady flow. All the PMIs on Friday. We've got core retail sales out of Canada. We've got those OPEC meetings. So again, there's just an awful lot of event risk, and especially with the Fed, right? A lot of things can change. Now, at the moment, pretty much market is pricing only a 25% cut in June. So clearly, if we get a cut, that would be a big surprise. And I think it's close 88, 90% in July. So that's pretty much a done deal. So that will be what the market is really focusing on. Yeah, as we discussed, in terms of where we are on the ES, really, it's much to do about nothing, right? Not a lot is happening, and again, it's just one of those situations where it's fairly clear that the market is waiting for new information, is deciding what it needs to do. So you see how we're basically just stuck exactly in this very, very tight range. And if you remember what we were discussing, I'm going to assume people follow the Twitter feed and follow what we discuss on the blog. But what we discussed is basically that a lot of people were getting very excited right here, okay? This was basically where Twitter was going crazy talking about a bearish engulfing candle. And what we said is not all bearish engulfings are created equal. And the way we look at things, again, we're not CMTs or anything, but the way we look at things are that the location is important. And this bearish engulfing happened below these previous highs, right at that old high we've got here. That's the key, pretty much 2880 line. And on top of it, it happened above the 50 DMA. So it's not like you have a bearish engulfing at a key confluence of a big fib zone. It's not like you have that triggering at new all-time highs or something. It's very different. So our base case was going into the week that we were still going to stay supported as long as we didn't get a daily close below the 50 DMA, and especially seeing the patterns we've seen in the futures market in general, right? In the markets, is we would be buyers of any weakness, especially into midday turn for the end of the day to play all those ramps that we've been seeing on equities, right? And especially on the Friday, right? Especially on the Friday, but every single day. So far, our outlook is still stuck inside this shaded range. And again, it's supported as long as it doesn't trade below the 50 DMA. Now, clearly this is a big zone and it's stuck. We'll have to see what happens into the FOMC, but really, right, this whole area, and it's not a cop-out, it's just where we are, this whole area is a huge chop zone, right? So the way I would still look at this is daily closes above the 50 DMA, it's going to be tempted to take a stab at all-time highs. If we get a close below, then it's going to be very likely tempted to come back and take a stab at this 2800, which is pretty much in line with the 200 moving average. So right here, it is what it is. You can will the market all you want, you can press it all you want, but that's just where it is. It's stuck and it's choppy, right? We have to see what happens. Now, also keep in mind that we've got that G20 coming in at the end of the month, etc. So we'll have to see, as everybody's trying to understand what the Fed is going to do, if Trump, what kind of games Trump is playing. And again, there's just so much risk. You have to be very, very patient. You have to be very, very patient. And unless we break out of this range, it's choppy. I mean, could it stay stuck inside this range all the way throughout the summer? Sure, right? It could. But again, we don't try and look that far forward. We'll just try and play the technicals as they trade up, right? So I think the most interesting places to play here clearly is at the 28 or at these new highs. That's where you'll get the nicest possible asymmetric risk reward. How's it going, Alex? Is it okay now? Those are the nicest place to trade in terms of possible bigger swings. And where we are right here is just a very tactical zone, okay? Now, yeah, I mean, in terms of the bigger picture, what we've been using a lot, what we've been trading a lot in general, we look at is the RTY as a control chart. And a lot of people keep on saying, well, if you look at the way the banks are trading, if you look at the way the regional banks are trading, if you look at the way the RTY are trading, it doesn't really look like we're very, very strong, right? And indeed, let's see if this works or this trading view is very slow. Let's see if we can load the RTY. The RTY, so the Russell is still holding fairly heavy. And this is a very interesting zone on the Russell, right? Because you see how it never managed to get bid back above that 1600 and it's holding heavy. And here what you have is a confluence of pretty much eyeballing it is the 50 back, 50% retracement of the move from A to B, right? And on top of it, you've got this multi-confluence of all the moving averages, right? You've got the 50, the 100, and the 200. So right now, yeah, I'm not, that we've talked about this before. This could be a good gauge of what's going on, right? Maybe you can easily say, well, as long as the Russell stays below this area, any rally in the broader indices is suspect, right? And I'll be more than happy to fade. But if the Russell starts to get a strong bid and break above these moving averages, above this 50 back, especially from a day close perspective, then you do not want to be fading the broader flows because likely we're going to trade risk on hard and we're going to try and press higher. Does that make sense? Yeah, exactly. So I think that's fair. That's the way I would look at it. That's the way I would be focusing on the equities. Cool, Alex. So that's the way I'd be looking at the equities. And again, we'll have to see. Remember that usually you get a lot of interesting opportunities around the Fed, so you really don't want to be positioned offside ahead of the Fed, and you don't want to be carrying too much risk. You know, we tend to be in close-only mode all the way into the Fed meeting or holding small positions or trying to build small positions, but the bulk of the trading this week for us will likely be done after the Fed, right? Not before. Yeah, sure. I mean, clearly the DXY is a huge piece of the puzzle, right? It's a huge piece of the puzzle. And I think I'm going to be boring here, but we've been talking about this for a long time, and our base case assumption is still that, and you can go back on previous videos, we've discussed this, both the longer term or secular, whatever you want to call it, bullish view on the dollar and the bearish view, and we think you can make a good case for both. But as long as you're stuck inside this 98, 96, you have to understand there's very little reason to get excited about any kind of move, right? It's just chop. The market is here and the market doesn't know what the hell is going to happen, right? And unless we start to make a move on rates, unless things become clear, very likely we're just going to be stuck here. Now, all things being equal, if you had to ask me as a trader or as a fairly active intraday trader, what would you want the dollar to shoot up to 100 or the dollar to shoot down to 92 or whatever? I would say no. I would be extremely happy with it doing nothing and just being stuck and being stuck inside this area, right? Because as long as I don't get crazy moves, but I do get moves inside range, you know, I can trade very aggressively, and I can probably even trade larger than if you're getting really big moves and it's going crazy outside of range. So I don't have a huge problem as long as it keeps on moving inside the 98, 96 mark, okay? Now, clearly here the market is pricing in 3 cuts, I think. So we'll have to see, and that's, you know, Powell's just going to be the key driver of what happens here. But our base case assumption is still that ultimately a higher dollar breaks a lot of things, breaks the world in brackets, right? Probably starting a wave of EM defaults and stuff like that. So we really think that not only in terms of and sparking a bunch of Trump tweets, I think the stronger dollar breaks a lot of things. So we would not have that as our base case scenario. But on the other hand, what I would say is you can't look at this in the traditional way. You know, people looking at this are trying to get a feel what's going to happen to euro, which is 60% or whatever of the DXY. Here you have to keep in mind, you have, especially as we go into the G20, you have to keep an eye on what USD CNH is doing, right? Here, the question is this going to break above the 7 mark? And everybody's getting excited about this breaking above the 7 mark. Again, I think it's just the level people are getting excited about, technicals or whatever, because it's a psychological level. But the actual number, to me, I don't think it's that meaningful. The question here is the PBOC, are the Chinese going to want this to rip higher like there's no tomorrow ahead of the G20 meeting? I mean, either they can't, maybe they want to do that to be, I don't know. But if I were in that position, I'd want to keep this as a rabbit I could pull out of my hat. So I'd be defending the 7 mark, right, until the G20, and then, you know, use that as leverage in the G20 or G20 or post the G20. So I don't expect this to break significantly higher ahead of the G20, but you have to keep an eye on this, right? It's a similar thing. As long as this stays in a fairly tight range, or the fairly tight range we've been seeing here, like the dollar, it's the same thing, right? You see how tight it's been here recently. Then you can probably be fairly aggressive trying to continue to play on that range on the DXY and try to fade some moves. But if you see this really ripping above the 7 going loco, you do not want to be stubborn on those moves. Or if you see this really repricing to the downside, you know, you do not want to start to fade. So I think this is a really key piece of the puzzle to give you an idea of how aggressive you can be on fading moves or calling BS on some of the moves you see. Okay, any comments, any questions? Yeah, clearly I continue to think that, and we'll have to see, it's a tricky call, but I continue to think that the moves on the bonds in terms of velocity has really been a little bit too much. So here you see how the ZNs are holding here, right? They're at a key zone because this is basically the 50 back of this whole move back down. and they've stalled this previous high we had here. They're stalling right here. So I think the move is a little bit overdone. Again, I'm always very careful about these, but as long as it stays inside this range, I think there's fairly tight asymmetry to try and play moves inside the range or the break back down. I would favor ultimately the 128 holding from a day close perspective and seeing this trying to come back down, you know, possibly into the 126s or 125s. And it's a very similar situation on the ZBs. Again, these are big boy contracts, so you want to be careful on these, but essentially here it's a similar thing, right? It's stalling up at these highs, and I would expect at least shorter term the 156 to kind of hold from a day close level, and I would expect this to come back down towards the 151, 151.50. I think that'd be a lot more of a healthier move, right? Yeah, I mean here on the DAX, let's see, do I have a shortcut here? Let's see if it's going to load. There you go. Does this look okay? So here on the DAX, yeah, I mean, there was a very, very nice long. I talked about this actually on Twitter also. And you see how we had this nice reversal that came back into the 200-day, right? I think a lot of guys also on Twitter, a couple of people wrote back into me telling me they played this. It's a very nice setup, right? We come back down to fill this whole area. You've got a nice reversal right at the 200 with these two opening gaps, and bam, we rip back and fill all of them. So very nice actions trading quite technically. I don't trade the DAX really. I prefer focusing on the US indices, but here, what time frame are you looking at? I mean, if you're looking at it from the bigger picture here on the weekly, you see how it's very similar to what's happening on across the board where we're stalling, right? Here you've got this area capping, which is a big pivotal level, and it looks like it's, you know, still holding the 1000 and trying to break. So this whole area is very, very choppy, right? Very, very choppy. I think it's a messy chart, and right here, similar to the equities, I would expect to see a lot of choppy trade around here, right? You've got the 100 on the weekly here and the 200 to the downside. I'd expect to see a lot of chop here until we resolve post the FOMC. And if you look at it on the daily, also it's just a messy chart, right? I don't see anything too interesting. Probably if we hold the 50 is going to try, it's similar to the ES, right? It's going to try and take a stab back at these highs. And if it loses the 50, it's probably going to try to take a stab back at the 200. But here it's just very, very messy. I don't think it's a particularly interesting chart to trade right here, right now. Yeah. You talked, I talked about that 132.50 on Twitter. I posted those. Yeah, this is another kind of crappy little messy little chart, but it's a good example of stuff which is very tradable. So I talked a lot about on Twitter right when we were trading into that 132.50. I said that's a pivotal level. It's a really nice level. She got a lot of chance to trade longs off this. You can see here, look at how nice this whole basing. I mean, you don't know what's going to happen, but what we like to do is look for asymmetry, right? So here we had the 132.50 as a big pivotal level, and look what happens here, right? We come back down, gap down, and look at this on the 1 hour, right? You see beautiful little hold, right? Gap down, holds the pivotal number, and then it trades back above, and then it's stuck, right? It's beautiful is that you see that that level is being supported, right? Now, you have no idea what's going to happen, but what you do know is that if this gap down holds, there's a good chance that it's going to try and clear the upper side of this range and possibly correct back higher, because that's a key zone. So this is a classical example of what we would be very interested in, because it gives you a beautiful asymmetric risk reward opportunity. What does that mean, right? Any buys here, right, into the lows, this is your risk, But since it's a bigger level on the higher time frame, your reward is very, very high, right? And you see what happened. 1 hour close back above the 132.50. Very nice little action. Then if you flip over, and again, that's why we talked about it. Look at it on the 4-hour chart, right? 4 hour, that 4 hour also closed positive. When it came back down, it held the pivotal number right again. Then you look at it on the daily. The daily closed back above. You see how, depending on your risk profile or depending on how aggressive you want, how many times you had to play how many chances you had to play this. Now, what was particularly interesting here was that it was in line with the 132 with the 200 on the daily. So the way we traded it, we scaled into the trade, very, very small on that 1 hour close, added a little bit on the 4 hour, and then added the full position once it was back above the 200 DMA. And it's very nice. I mean, in terms of the bigger picture, this is a chart that I've been posting for a long time, is that we were looking for potential completion of this whole symmetrical move all the way back to 139s on CAD. Now, what kind of threw a little bit of a wrench in the spanner, which is not ideal, is that here, right, it's made a lower high, right? A lower high. So it's not as ideal as it would have been if this ramp here had made a little bit of a higher high. Even that would have been much nicer setup. But you see on the weekly here, the moving averages are all still in trend and they're all supporting. So, we'll have to see. And again, most likely this is going to be down to, what the market does. The correlation between this, crude, and stocks, fairly classical stuff, right? Nothing too crazy, right? Yeah, so again, I think I know a lot of people, a lot of the blogs and stuff say, you need to just look at one chart all the time and become a specialist in one chart, etc. I don't really believe that. I think, of course, different charts have, different instruments have different personalities and they can trade a little bit different. But we believe that a solid system or solid trading strategy that has edge is applicable to pretty much every chart, right? As long as you can chart it, it should be applicable. And we find that limiting ourselves to one instrument is extremely limiting, and it's a little bit of a waste of the time and effort that you put into learning how to trade, developing an edge, understanding market action, price action, etc., etc. So I think what makes sense is to have an understanding of how a market tends to move, how price tends to move, how to take advantage of different opportunities at different key points in the market, looking for some kind of asymmetric risk reward if that's the way you trade, or trying to take advantage of whatever way you try to trade. But then some markets just stop moving, right? Some markets go nowhere for ages. And there's different cycles, there's different dynamics in place. So we think it's extremely limiting to not have a broad approach and look at whatever asset class is moving or whatever charts. Clearly, we don't think you should be looking at a gazillion charts, 30 instruments, 40 instruments. But I think really, especially if you're trading full time, there is no reason why you can't keep an eye on 6 to 9 markets or something like that, 12, 10 markets. There's really no reason, in our opinion. Then everybody's a little bit different. Any other chart? Anything else anybody's looking at? We're going on 23-minute mark. I wouldn't want to go over the 30-minute mark because then it just gets a little bit of a pain to upload to YouTube for everybody. No, I haven't covered crude. Let's look at crude, my friend. So what's happening on crude now? As I discussed on Twitter too, you've got a lot of event risk here, and no matter what the setup is, there is no way when there are crazies torpedoing tankers that I'm going to go short crude into the weekend, no matter how good the chart looks, right? Even though it wasn't, right? So you have to be a little bit careful here. In terms of crude, nothing has really changed, right? This is the weekly, and this is the chart we're using, is essentially we're stuck here. And our base case was that coming back down into this level. So if you remember, Tim, we talked about the weekly negative close at the 62.50, and we were looking for that to trade back into the 55, and we said the percentage play was to flatten up into that 55. So clearly we flattened up a little bit too early, and this got very aggressive to the downside. Then what we said was particularly interesting as we came back into these lows is you had a number of interesting factors, right? Not only you had the 200-week moving average here, right? And then you're also getting into that psychological 50 mark, right? You know, that break-even level for shale producers, etc. So we expected it to find a bid inside this zone. And you saw we had a fairly nice reversal on the weekly, a fairly tradable weekly positive close around that 200. And that was, you know, nice little chance. Here, the problem is all the headline risk. Our base case hasn't changed here. As long as we don't get a daily or weekly close below the 50 mark, we think the technically the risk is for this to bounce and go back into this 50, 200. Now, clearly, if you get more torpedoes flying around, that'll probably help the technicals, right? But the thing you have to keep in mind here is clearly if we take out that 50 from a day close perspective, I wouldn't be surprised to see $5 to the downside come quick and in an ugly manner. So you have to be fairly careful here. I'm not a huge fan of trading crude right here, right now, also because of the wheeling and dealing that's going on and the headline risk. But if I had to look at something, I'd be more biased to looking at the fact that this is trying to hold this whole area, and the potential is for a potential bounce all the way back into the 60 mark. Okay, that's the way I'd be looking at it. Okay, any comments, any questions? Anything anybody's looking at? Yeah, you know, here we'll have to see basically, it's, you know, there's I think all the FX charts are fairly clear in terms of where they're trading, where they are in terms of trend, where they are in location. It's just a question of what is Powell going to do on Wednesday? Is the market going to have to price in more rate cuts or less rate cuts? And that's the game in town now. So there's very little reason trying to you know, to take huge bets now. We have to wait to see what Powell does on Wednesday, and then, you know, we'll know. I mean, if it's a shocker, if it's a real shocker, you'll have plenty of time to get into the resulting trades because nobody's going to be able to reposition in a second on Wednesday, right? So the repositioning will likely take some time. But if it's not a huge shocker, there'll probably be a lot of short-term trading opportunities, and then we just go back to where we're trading the outlook we had and the charts we're looking at. But again, I think the beginning of June has been extremely interesting. There have been a lot of opportunity. I know a lot of people are up well on the month. So again, I would be very, I've been discussing this on the blog too, you know, don't get too aggressive, right? If you've had a good start to the month, take it easy, dial in your risk, and take advantage of the opportunities after FOMC. No need to really try and pile in before. But remember, there's a lot of event risk all week, okay? And probably all the way back down into the G20 meeting, okay? Excellent stuff, guys. So it was good. It was fun spending some time with you. Thank you, everybody that popped by. Have an awesome one, and you know, next time markets are a little bit slow, we'll do another one of these if you guys enjoy them. Have an awesome one. All the best, guys. Take care. Bye-bye.